Listen closely for just a moment, because this truth is usually realized only when it's too late. Your bank can suspend your account today, and if the situation worsens, erase its existence tomorrow. Whether you made any mistake or not will not be considered. And in 2026, this reality will strike millions of Americans, most of whom never imagined such a thing could happen to them. The current situation is alarming. U.S. banks now stand on an invisible shortfall of nearly $517 billion. Credit card payments have reached a 12-year high in overdue balances. Car loan defaults have risen again to the highest level since the last recession. The quietest but most serious announcement came from the FDIC. They admitted, if just one big bank fails, their insurance fund will be depleted instantly. In simple terms, if your savings are lost, you will not get them back. Not tomorrow, not ever. This is not just a story for the careless. It's for families who budget every penny for groceries. It's for working people who struggle to make it through the month. It's for seniors who believed their life savings would safeguard their future. Until one day, they pick up the phone and see the message, "Account restricted," and the bank's customer service suddenly goes silent. This is not speculation. This is an ongoing countdown, and its clock has already started ticking. The rule almost no one has heard of is now slowly rising in America's banking system, the FDIC bail-in model. People still think the small FDIC insured sticker on the bank door provides absolute protection for their money. But they don't know, the sticker hides a completely different reality. After the 2010 European banking crisis, global financial regulators introduced a quiet change. No longer would taxpayers' money be used to rescue banks. Instead, the decision was the depositors' money will be used if necessary. The first test of this policy was Cyprus. One morning, people woke up to find up to 60% of their bank deposits had been taken to save the bank. And the most shocking fact is, the United States approved the same type of legal framework in 2014. Yes, it's U.S. law. It's legal. But most of the public doesn't know it is enforceable. The Dodd-Frank Act gives the FDIC and Federal Reserve direct authority if a major bank faces collapse. Customer deposits can be used to rescue it. If Bank of America, Citi, or Wells Fargo gets into deep water in 2026, which, by the way, many analysts are already predicting due to unsustainable commercial real estate exposure, guess whose money is first on the chopping block? Not the executives, not the shareholders, yours. The FDIC has already made it clear deposits are legally considered unsecured liabilities of the bank, meaning if your bank fails, you're an unsecured creditor, not a priority. And with only $124 billion in FDIC reserves backing over $18 trillion in deposits, it's a cruel joke to believe they could save everyone. That's less than 0.7% coverage. You don't need a tinfoil hat, you just need a calculator. If a single major bank falls in 2026, the cascade will be instant, and millions of accounts will be locked, frozen, or partially confiscated in a matter of hours. This isn't some sci-fi scenario, it's the law. It's already here. You just haven't heard about it on CNBC yet. Real-time digital payment rails are coming, and they can be switched off in a heartbeat. If you thought the days of your bank processing your money slowly were coming to an end, you're right, but not in the way you think. While the mainstream media cheers on things like the FedNow service, a real-time payment network launched by the Federal Reserve, they're leaving out one massive world catch: total transaction control. FedNow is not a consumer-facing app. You can't download it, but it's the infrastructure that every U.S. bank is being pushed to adopt by 2026, and it's lightning fast. Sounds good, right? Except this. With that speed comes programmability, meaning your access to money can be restricted, frozen, or redirected in real time. Your payroll deposit delayed because of a glitch? Your payment to a politically sensitive organization flagged for review. Your grocery bill at 2 a.m. declined for suspicious behavior? And here's the part they won't admit publicly. This is the exact same framework that central bank digital currencies, CBDCs, are built on. The same FedNow rails that speed up your Zelle transfers, they also make it easier to shut off your account at the push of a button. Sound dystopian? Tell that to Nigerian citizens who watched their bank cards stop working during protests, or Canadians whose accounts were frozen for donating to the wrong cause. It's not science fiction, it's digital plumbing. And once it's installed, it's there forever. By 2026, nearly every major U.S. bank will be fully integrated into this system, and you won't be able to opt out. Because guess what? FedNow will eventually replace existing payment systems like ACH and SWIFT. It's all part of the modernization push. And here's the scariest part. Once everything is instant and programmable, errors become irreversible. You won't be able to call your bank, file a dispute, or reverse a mistake. If a hacker gets in or a government watchdog doesn't like what you're doing, it's game over. You blink, your balance hits zero, and there's no human behind the curtain to help. The rails are silent, but the control is total. Banks are selling your real-time data to AI surveillance firms, and you already gave them permission. Do you remember checking a little box when you opened your bank account that said, "I agree to the terms and conditions"? Of course not. Nobody does. But buried deep in those 12,000-word privacy agreements is something most Americans would lose their minds over if they actually read it. You've given your bank permission to share your transaction history, location data, and spending habits with third-party analytics firms. Bought gas at 3 a.m.? Flagged. Transferred money to a relative in a high-risk zip code? Noted. With AI tools like Palantir and Chainalysis already used by federal agencies, banks are now beginning to deploy similar software to create risk scores that have nothing to do with your credit. They're building behavior models. And the scary part? These scores are already being used to throttle access to financial products. You might apply for a line of credit and get denied, not because of your FICO, but because your digital twin raised a few eyebrows. And here's where it gets uglier. New financial compliance rules like Section 1033 of the Dodd-Frank update will force your bank to share all your data with third-party services at your request, which sounds empowering until it becomes the norm for every fintech app and payment gateway. Now your life is scattered across cloud servers. Nothing is private. And if and when a breach occurs, and with nearly 5,000 financial data breaches reported in 2024 alone, it's not a matter of if. Your entire spending history could be sold on the dark web for pennies. Combine that with real-time access and programmable restrictions, remember Step 9, and you're looking at millions of Americans waking up in 2026 with locked accounts, suspicious flags, and zero recourse. They'll say it's fraud prevention, but it's surveillance, and we all opted in without even realizing. Financial institutions are getting crushed by shadow bank contagion, and your account is the collateral. Nobody wants to talk about this because it's complicated and ugly, but you need to understand this before it's too late. There's a whole world of finance that doesn't show up in the headlines, the shadow banking system. These are unregulated entities like hedge funds, private credit firms, money market funds that aren't technically banks but still move trillions of dollars in the global economy. In fact, according to the Financial Stability Board, over $239 trillion is now circulating in the shadow banking sector worldwide. That's more than the entire global GDP. And here's the part that affects you. Traditional banks are deeply intertwined with these entities through hidden liabilities, off-book exposures, and rehypothecated collateral chains. Basically, your bank has been lending your deposits to third-party firms that then re-lend that money 5 times over in complex derivatives trades, all without FDIC oversight. And in 2026, if even one of those major counterparties collapses, say a hedge fund that's overexposed to crashing commercial real estate or sovereign debt, it could trigger a massive cascade failure across retail banking. We saw a tiny glimpse of this in 2023 when Credit Suisse imploded, and in 2024 when regional banks like First Republic and Signature Bank folded. But this time, it'll be bigger, faster, and more contagious, because now there are smart contracts and AI trading bots operating in decentralized finance platforms that move billions in seconds, and your bank's exposure to these platforms is often completely opaque. In other words, your checking account is the safety net for a hyper-leveraged house of cards. And when that house starts shaking, your account gets frozen as a precaution, or drained to cover liquidity shortfalls, or worse, converted into restricted credit while the courts sort things out. If that sounds insane, remember Lehman Brothers was rated investment grade just 24 hours before it died. You won't see it coming, and your bank won't warn you. They'll just flip the switch. And when they do, it's not Wall Street who pays the price, it's Main Street. It's you. Your bank is already on a digital death watch list. They just haven't told you yet.
More than half of the banks in America are technically insolvent right now. You heard that right. The math doesn't lie. According to a 2024 report by Stanford and the National Bureau of Economic Research, over 2,100 U.S. banks are holding more liabilities than assets. Meaning if everyone pulled their money out tomorrow, those banks would collapse on the spot. This isn't just the mom-and-pop credit unions in Iowa either. We're talking regional giants that are hanging by a thread because of one thing: unrealized losses on their bond portfolios. During the 2020-2022 zero-interest free-for-all, banks scooped up long-term treasury bonds thinking they were safe. But when interest rates skyrocketed under the Fed's inflation fight, those bonds tanked in value, and suddenly, banks were sitting on billions in paper losses. The only reason this hasn't turned into a panic yet? Accounting magic. As long as they don't sell the bonds, they don't have to realize the losses. But guess what? In 2026, loan delinquencies are projected to surge, especially in the consumer auto and commercial real estate sectors. That means banks will be forced to sell assets at a loss to cover the defaults. And when that starts, it's game over. The FDIC has already been quietly running resolution drills with major banks to prepare for mass failures, but the public completely in the dark. There's even an internal classification system where regulators rank banks as watch, deteriorating, or critical. Think your bank is safe? You wouldn't know. They're not required to tell you. And when the dominoes fall, they'll fall fast, just like Silicon Valley Bank. One tweet, one withdrawal wave, and poof, your money's behind a frozen login screen. When it comes to 2026, the only thing worse than not knowing your bank's about to fail is finding out when it's already too late. Commercial real estate is the next big collapse, and it's dragging your bank with it. You want to know what's rotting beneath the shiny surface of the U.S. economy right now? One word: offices. Empty, unpaid for, and bleeding cash faster than anyone wants to admit. Let me break it down. Over $1.5 trillion in commercial real estate loans are set to mature by the end of 2026. And here's the ugly truth. A huge chunk of that debt was based on 2020-era valuations when interest rates were near zero and remote work wasn't permanent. But now, offices in major cities like San Francisco and Chicago are seeing occupancy rates under 45%, and property values have collapsed by 40 to 70% in some markets. That's not a soft landing, that's an implosion. Now, here's where your bank account comes in. Regional banks hold nearly 70% of all commercial real estate loans in America. That's right, the same bank where you keep your checking account is sitting on a ticking time bomb of bad loans from ghost town office buildings. And as those loans default, which they are at an accelerating rate, the banks have to write down their assets, which eats into their capital reserves, which forces them to raise money, which they can't do because no one wants to invest in a failing bank. So what happens next? Liquidity crisis, deposit freezes, account limits, withdrawal restrictions. Sound familiar? It's the exact script we saw with First Republic Bank, except this time it's nationwide. And the regulators? They can't save everyone, not with over 4,000 smaller banks on the hook. When that commercial real estate floor finally caves in, and analysts say Q2 of 2026 could be the stress point, your money is going to be trapped under the rubble. And don't expect a warning. These banks will hold out until the last second, then quietly merge with a bigger institution overnight. Your login will still work until it doesn't. And by the time you realize your account has been folded into a liquidation event, it's too late. You're already part of the bailout. Social credit is creeping into banking, and 2026 will be the year the door slams shut. Most people think social credit is some creepy thing happening in China with facial scans and state-sponsored apps. But what they don't realize is that it's already here in the US. And by 2026, your bank account access could be directly linked to what you say, who you donate to, and how well you follow the rules. Don't believe me? Look at what happened with PayPal in 2022. They tested a policy that allowed them to fine users $20,500 for spreading misinformation. Now ask yourself, what happens when this kind of policy gets quietly baked into the terms and conditions of your bank? Major institutions are already using reputation scores to determine access to services. In 2024, several credit unions began piloting programs that evaluate customers not just on financial behavior, but on behavioral patterns like the content of your social media, the websites you visit, and even your political donations. And they're using AI to automate it. The World Economic Forum has openly pushed for inclusive banking standards tied to ESG metrics. And guess who's listening? MasterCard, Citi, and Bank of America, to name a few. In other words, if your lifestyle doesn't align with the right ideologies, your access to financial services may shrink. In 2026, this goes mainstream. The infrastructure is already in place. Banks have been rolling out AI compliance tools under the guise of fraud prevention and risk scoring, but the scope keeps expanding. What started as a system to detect terrorists and money launderers is now being used to flag everyday users for unusual activity. And here's the trap. There's no transparency, no appeals. You just wake up one day and find your debit card declined, your app frozen, and your compliance review pending. You call and they say it's under investigation. You wait and they say they're reviewing your case. But weeks go by, and your money, it's still locked and you're still flagged. And just like that, you're debanked. No crime, no trial, just an algorithm and a policy update. That's what 2026 is shaping up to be. The year social credit goes private and no one's bank account is safe from it. Executive Order 14067 opened the door, and now CBDCs are practically guaranteed. Your money is about to expire. You think that sounds dramatic? Let's talk about Executive Order 14167, the one almost nobody read, but everyone will feel. Buried in that 2022 White House directive was a quiet call for the U.S. government to explore the development of a central bank digital currency, CBDC. It didn't make headlines, it wasn't shouted from podiums, but the gears started turning, and by late 2025, a full-scale pilot program of the digital dollar was already underway through the New York Federal Reserve's Project Cedar. You didn't vote for it, you weren't asked, but they've been building it anyway. And in 2026, it's set to move from pilot to public rollout. Why does that matter? Because a CBDC is not like Bitcoin. It's not freedom, it's not privacy. It's programmable money, meaning the issuer can determine how, where, and when it's spent. The government could limit what you can buy with it. They could set an expiration date on your savings to stimulate spending. They could freeze it instantly if your behavior doesn't meet guidelines. Already, the Bank of England and the ECB have published white papers supporting exactly those features. The US is not far behind. Treasury officials have already admitted they're exploring behavior-based currency controls to combat climate violations, tax evasion, and extremism. You don't need a wild imagination, you just need a subscription to the Federal Register. Once the CBDC becomes active and banks integrate it into their core systems, millions of traditional bank accounts will be forcibly converted. You'll wake up to a mandatory update, and suddenly your dollars will have rules attached. Your $5,000 savings? It might only spend on approved merchants. Want to pull it out in cash? Good luck. The ATM just shows unavailable, see branch. And the branch already closed.
This isn't a what if, it's an active rollout. And if you don't prepare now, your financial autonomy and your bank account will vanish into a permissioned blockchain you'll never control. Global banks are rehearsing massive cyber attack simulations, and you're the test subject. Most people are focused on the wrong apocalypse. They think the next disaster will be inflation or China or another pandemic. But while everyone's distracted, the real threat is coming in through the wires. A planned takedown of the global banking system under the cover of a cyber event. It's not a theory, it's already being practiced. In fact, in late 2023, the Bank for International Settlements, the IMF, and over 100 central banks and commercial institutions ran a joint exercise called Cyber Polygon. The scenario? A massive ransomware attack shuts down core financial infrastructure, payment rails, clearinghouses, and customer interfaces. Sound familiar? The simulation mirrored what the World Economic Forum has been warning about for years, a cyber pandemic that makes CIVIC look like a blip. Klaus Schwab even said it himself. The next crisis will be far more disruptive and far more impactful than the pandemic. Why does this matter for 2026? Because another simulation is scheduled, and this one's different. According to insider leaks from participants at the Bank of England and HSBC, the next drill will not be announced in advance and may include live system lockdowns to test real-time response. Translation? Banks could go down temporarily, and you'll be told it's just a drill. But when your app doesn't work, when you can't pull cash from the ATM, when your debit card gets declined at the store, how will you know if it's a simulation or the real deal? And that's the whole point. The lines will blur, and when panic sets in, people will flood the system with login attempts, transfers, withdrawals, and guess what? That's when the banks will seize the moment to reset the system. They'll blame hackers, they'll freeze access, they'll roll out new protocols, new terms, and yep, new digital currencies. By the time it's restored, your old account may be gone, converted, restricted, audited. You'll be told it's to protect your funds, but the truth? Your account was just wiped under the guise of global cybersecurity, and nobody, not your bank, not your government, not even your lawyer, will be able to stop it once the switch is flipped. The great consolidation is the end game, and your bank account is just step one. This is it, the final act. The part they won't say out loud, but every insider, economist, and central planner is quietly admitting behind closed doors. Banking as we know it is ending. In 2026, we are going to witness the largest consolidation of financial power in history. The plan is already in motion. Regional banks phased out, credit unions absorbed, independent lenders eliminated or bought. All roads lead to 4 or 5 mega banks, tightly regulated and fully integrated with Federal Reserve infrastructure. Why? Control, efficiency, surveillance, and most importantly, resilience to collapse. But guess what has to happen first? Millions of ordinary bank accounts like yours need to be purged, absorbed, reclassified, or shut down. That's why small accounts are being hit with new maintenance fees, balance minimums, and inactivity closures. It's why banks are merging branches, slashing staff, and automating everything. It's not just to cut costs, it's to trim the herd ahead of the transformation. The unbanked will be lured into CBDCs, the non-compliant will be locked out, the low-value accounts will vanish, and those who remain, they'll be swept into a fused Fed bank hybrid where every dollar you hold is a tracked, time-stamped entry on a ledger you no longer own. They'll call it upgrading financial inclusion, but the reality is simple. They don't want 10,000 banks with unique policies and protections. They want 5 nodes, 5 portals, 5 pressure points. And once that's done, there's no going back. Your money is no longer your money. It's just a permission slip. Spend it the wrong way, revoked. Save too much, taxed. Move it too quickly, flagged. And when that system is fully online and the consolidation complete, the average American will realize far too late that their entire financial identity has been rewritten. Millions of accounts will disappear, not because of hacks, not because of fraud, but because they were never meant to survive the transition. You were just a line item on a ledger, and in 2026, that line will be deleted with surgical precision. So, here's the bottom line. If you're still pretending that everything's going to be fine, you're not paying attention. You've got collapsing banks hiding losses behind fake accounting, digital currencies being fast-tracked behind your back, and central planners rehearsing cyber accidents that conveniently reset the system. And you're the one they'll erase first, because you don't have lobbyists, you don't have legal teams. All you have is a checking account that they can freeze with one keystroke. And in 2026, they won't ask, they won't warn you, they'll just do it. Your life savings gone, your transaction history flagged, your options none. You can scroll past this and pretend it's just internet fear porn, or you can wake up and realize the purge is coming for your money, and they already built the tools. The only question left is whether you've got a plan or whether you're going to be another line in the FDIC's Monday morning spreadsheet labeled liquidated. Prepare now, because once they flip the switch, there's no undo button.